Okay, I'm getting the signal that we're just about ready to start here. So to begin this week's webinar, we're looking at the weekly outlook for the U.S. majors, specifically how to trade the major pairs for the week of April the 21st, 2014. We're looking at very powerful setups and how to apply them. Also identifying who is controlling the market, the bulls or the bears. This is something that I think a lot of people get confused by putting on too many indicators. We're looking at key breakout points to watch and supply and demand basics with accompanying indicators for momentum trading. Now, just a little bit about myself. My name is Greg Firman. I've worked in the futures and Forex market for the last 12 years, and in 2006 founded E-Trade FX. I am Series 3 Commodity Futures licensed and Series 34 Retail Forex licensed and registered with the CFTC and the National Futures Association as a commodity trade advisor. I've also worked with a number of large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading, while also providing very specific risk management tools, with preservation of capital, of course, the primary focus. Now, I've further worked as a market analyst for TraderPlanet.com since 2008, a prominent free social media website that globally connects traders, where I provide daily commentary to a large number of followers in the Forex, futures, and stock markets. So with that said, let's get started. We've got an action-packed event here today. I hope everybody's comfortable, and I want to welcome everybody and thank everybody for attending here this morning. And of course, FX Street for hosting. Now, what I want to talk about here is how to trade these majors and what we really want to look for. Now, understanding Forex predominantly is buying or selling US dollars, guys. That's what it is. When we break it down to its most simplest form, so we really need to focus on that. A number of brokers have their own version of the US dollar index, where they've added the Aussie dollar, the Kiwi, they try to make up their own dollar index, but it is not as accurate as the actual US dollar index, which is, of course, the DXY futures contract. Now, I've talked about this in my past webinars here, where we can get this for free on the Windsor Broker platform. I do not broker for them. I have no affiliation whatsoever with Windsor Brokers. However, they offer some very unique features on their platform, where they offer futures contracts on the US dollar index, the S&P 500, gold, silver, NASDAQ, all the main driving factors when we base things around intermarket analysis, because we know that one market is driving another market, the equities sell off, the dollar gets stronger, and vice versa. These intermarket correlations are very, very important. So we want to look at how we're going to trade this. And so the primary focus is we want to look at that dollar index and make sure we have a good understanding of what's happening on this. Now, what I'm going to do here, you can see I'm on the monthly time frame. I have a series, not very minimal indicators on here. And the primary thing I want to talk about when we're looking at powerful setups and how to apply them, we always want to use price action in combination with technical indicators. We do not want to use technical indicators by themselves, in my respectful opinion. And this is what I work on with my own direct clients, that it's very, very dangerous to trust an indicator that 70% of the market is using, when 70% of the market by CFTC data are not making money, okay? So that's a tidbit that you really want to put into your hat and understand that's statistical data and it's factual, at least with the brokers in the US. So when we look at this right now, by price action, we want to look at a few different things here. We want to look at supply and demand, and we want to look at who's actually in control here, the bulls or the bears. So a quick and easy way to do this is, if you'll notice here, I'm going to check the opening price for the month of April on the US dollar index. The opening price for the month is 80.26. So right now, this tells me that the bears are theoretically in control. And the very easy way to apply this without complex Elliott wave, Fibonacci, all of these complex theories that really don't have a lot to do with trading, to be perfectly honest. Particularly Fibonacci really has nothing to do with actual trading. So when we look at price action, we want to look to see who's actually controlling this. Right now, if the opening price is 80.26 in the dollar index, the high for the month we can see is 80.76, but predominantly in the month of April, we have been below that opening price. We're also below, when we start working our technical indicators into this, we can see we're below the 100-day moving average. This is a fantastic moving average to use. Then we have additional indicators in here, moving averages. So we're not looking for a crossover here, guys, of these moving averages. We're looking for these to act as pivot areas. So on the 25-day moving average, that's coming in at around 81.08. And then this all-important 6-day, which is coming in at 80.39, which coincides with that opening price. So when we look at this, and when I'm talking about very powerful setup, we want to start moving backwards here a little bit. We want to come into the weekly. We're starting a new week in the dollar index. So we want to look at this and say, okay, are we bullish or bearish on the dollar index to start this particular week? We know we're bearish on the monthly opening. Now we've got to break it down into the actual weekly. So if we look at this, you'll notice here or on the left side of my screen, the opening price is 79.91. We're currently trading at 79.95. So we're very mildly bullish on the dollar. And I want to stress that term mildly, okay? Now, when we look at supply and demand areas here, to draw in proper supply or proper demand in this particular case, we're looking for a low point in the market, and we're looking for 2 candles to the left and 2 candles to the right that are higher than this lowest point. This creates a potential demand line. We then want to match it with current price action. So we're actually drawing our trend lines here from right to left because we have to allow this to form. So you can see that right here, I've connected the trend line to this candle right here, which comes in at about the 79.26 area. And then my trend line is drawn across from there. So that tells me we have demand for US dollars down at this level. So that's very important to remember that we want to combine this with the opening price for the week and where there is actual demand for the US dollar index against a basket of currencies. So we can determine right now, we want to come right under this lowest candle that we have demand down to 79.42. So things actually look a little bit bullish for the dollar, but when we start bringing in, our additional indicators to gauge this, we can see that we're below the 100-day moving average, 86.66. I've got a 25-day simple moving average in there at 80.43. And then I'm going to bring in my 6-day at 80.05. So basically, I can stagger my resistance points starting at the 100-day and moving down to the 6th. And then, of course, this very, very important demand line down here. Now, I also want to identify supply. Supply is considerably higher up at this 81.44 area, which basically we haven't been able to get past the 100-day moving average even for the last 1, 2, 3, 4, 5, 6, 7, 8, the last 10 weeks here, guys. So when we look at the US dollar, and I'm going to briefly touch base on this, and then I'm going to move on to the currency pairs, that basically the dollar is structurally a mess. And it has been a mess for at least 10 years. So when I've talked about this in the past webinars, you can see that if I zoom this out a bit, this paints a very ugly picture for the US dollar. Essentially, when the market crossed over the 100-day moving average back in May of 2002, it never really looked back. It came back up and it went back down, but predominantly it has not been able to cross over that area for this entire time. And then we have this massive supply area. So supply is filled, price goes lower. That's how this works, 84.27. We have not been able to get above that since 2010. So when we look at the bigger, broader picture on the US dollar in general, it's not pleasant. So the toughest trade in my career in trading Forex realistically has been buying US dollars. But we have to do it because we could get on a dollar rally for several weeks, maybe even several months. But don't ever lose sight of the fact that when you're buying dollars, that would be selling Euro US, selling Great Britain US, selling Aussie US, because the dollar is the common denominator here in all of these currencies, right? In these currency pairs, in the majors, right? So when we look at this, we really have to take a step back and say, okay, well, every time I sell Aussie US, I'm going against a primary broader structural trend, and that's a downward trend in the dollar. Now, a lot of analysts are talking about higher yields, and that's going to boost the dollar, and it probably will for a few weeks or maybe a month, but ultimately the dollar pulls back. and it pulls back and it pulls back, and it's just deeper and deeper and deeper. So the twin deficits in the U.S., the political situation in the U.S., nothing really bodes well here for the U.S. dollar, to be perfectly honest. So now Sydney is asking, do I need to go to bed, or it's after midnight? Hope you can record. Hope you can send a recording. Yes, I'm sure. Contact FX Street here. I'm sure they will be able to assist you with that. Now, as we come into really looking at the dollar, we want to make sure that we understand that we want to watch the opening price in the monthly. Right now, we're 3/4 of the way through the new month. Okay, so we're mildly turning bullish. So if we come back down to the daily, okay, so we know that we're below the 100-day EMA, the weekly, the monthly. We look at the daily now. We again have demand down here at the 79.42 on the daily also. Looks like we're building a base down here for a potential dollar rally. The dollar predominantly is stronger during the months of May and June, but this year it's been hit with new Fed, weaker unemployment numbers, U6 number not that great, what I talked about earlier this month. So all of these things kind of add up against the dollar. So again, we're mildly bullish on it, but not to any real extent. So when we look at this, we also want to look at the opening price of the day. The opening price today is 79.91. Now, today is not the perfect gauge of price. Tomorrow will be, because it is Easter Monday. A lot of countries have today off. The banks are, so a lot of the major banks at least in Canada, are closed. I think the UK and the US are similar. So we have to take that into consideration. So what I do want to briefly touch base on here from the intermarket standpoint, we've had a good look at the dollar, is how the equities are playing into this. Now, the equities here, when we look at the equities on the monthly opening price for the equities is 1863 on the futures. Now, this definitely plays a role into what we're doing here. And what I'm saying by that is, at 1876, the current price, we want to look at that monthly opening, excuse me, just for one more minute. The opening price at 1863. And you can see that the market is struggling with the opening price. So a lot of my futures guys, they chase this S&P 500 wildly. But the bottom line is, here we are. We've opened the month at 1863, and we're sitting at 1862.50 21 days later. Okay, so when we look at that, again, we've got the low for the month of 1803, the high at 1892, but your key pivot area is around this 1863. So if we break above 1863 and the S&P 500 goes into a bullish mode again, that is going to have a negative effect on the US dollar. So keep that in mind, okay? Keep a very close eye this week and next week on 1863. So if we stay below 1863, we want to think about buying US dollars. If we get above 1863, we want to think about selling US dollars. And buying or selling US dollars, again, that's a very simple trade. If you're selling US dollars, you're buying Aussie US. If you're buying US dollars, you're selling Euro US. So to keep it very simple. Now, what we want to do is look at other factors that are going to drive that US dollar. The other thing is gold. Now, we have to look at this from an intermarket analysis standpoint. The opening for the month is 1283. We're currently at 1286. So again, a lot of you guys with your Europeans, Canadians, and some of the US guys, you have gold on your MT4 platform, and you have access to gold pricing. The opening for gold pricing here is 1283. So here's what I'm going to give you for this. If we're above 1283, we want to sell US dollars. If we're below 1283, we want to buy US dollars. Okay, so keep an eye, jot these numbers down on the presentation so you know these key pivot areas. And remember, today is not a great days. That's why I'm coming out to the monthly, because the monthly is very, very important. So if the theory here is that if we're above the opening price of the month, we're bullish. If we're below the opening price for the month, we're bearish. So that tells us who's in control of the market, the bulls or the bears. And it can be done as simply as that. You don't need complex mathematical formulations. It comes down to price action, and then it comes down to combining technical indicators with that price action. So what I want to do is get into the currency pairs, because I want to stay within my 35, 40 minute allotted time here. Great Britain, U.S. This is something that since basically I started acting as a contributor here on FX Street back in I think it was November, December, that I had talked that I was quite bullish on the British pound. So the fundamental I'm going to give you on this one, I reside in Canada. So basically, the former head of Canada, Bank of Canada, Governor Carney, has left the Bank of Canada and he's gone to the Bank of England. He's now running the show over there. In Canada, Carney was notorious for talking up the local currency, and he's already doing it in the UK. So in Canada, he drove the Canadian dollar to record levels against the Canadian dollar counterpart. I believe he will do the same thing in the Bank of England. I believe a lot of what he does and says is scripted, and it will continue. So that may be good, maybe bad. I have clients in the UK also, and they say that if they come to Canada or the US, they're sick and tired of this exchange rate. They want a stronger dollar. Well, Canadians said the same thing. Okay? Canadians said, we don't want a weak dollar. We want a strong dollar. Well, once they got that strong dollar, that came with very severe consequences. And that specifically was the loss of manufacturing, and it took a damaging effect on the middle class. That could happen in the UK also. So all I'm doing is pointing out, if there's people on the webinar here today from the UK, be careful what you wish for. Okay, so a stronger currency is not always a good thing. That's why a lot of these central bankers try and talk their currency down. So right now, we're going to look at this, the opening price for the month, 166.60. We would remain long while we pulled above this level. This level is a very, very strong level. The upper Donchian band broke 3 months ago. We're starting to level off again around 168.21. I believe that this area will be taken out in the coming months. Maybe not this week, maybe not next week. But how we trade this week is we know that we have massive resistance up here. There's no question about it. When I bring this in on the weekly, you can see, and I'm sure I'm not the only person who says this, and I'm sure this isn't the first webinar you've seen where somebody's pointed out this trend line resistance up here. But the main thing you want to understand is right there, the opening price for the weekly, 167.81. As long as we stay above that area and above 166.60, the bulls are in control. Okay? That's the easiest way for me to say this. We then want to bring our technical indicators in there and look for key areas below that. So when I look at this, again, 166.64, the weekly bottom trend line support, 165.90. They tried to push through that last week, and the bears were knocked right out of the park. The bulls clearly took over this and drove this even higher. Now, this is the second time we are back up here in the last 6 to 8 weeks. This is not a bearish setup. This is a very bullish setup. When you take into consideration everything I've said on the dollar, don't be afraid to buy a breakout scenario. So if we lose this 168.21 area and we get a sustained break above this level, the bears could throw in the towel completely and say, you know what, that's it, we lose. Jump ship, get on the bull camp. That's a very likely scenario, but the brokers are going to try and run the stops first before that happens, because you can see we got up here and then they drove it all the way back down to 165, but then it just turned around right off that trend line and back up it went. So when we look at things on the daily, you can see that we've got this big resistance at 168.17, but we're staying very close to it. Okay, so on the daily for this week, 167.20, between 166.60 and 167.20. If we can even get down to that level, that's definitely a buy zone here, guys. It's definitely a buy zone. And that's what I want to point out. When we look at these, you can see that the upper Donchian band is way up here at 168.41. That represents the most recent high that we've had on this, but that's a much higher high. Even though it's not huge, it still points that that's a bullish signal. Okay, so keep that in mind. The pound dollar, the key levels there. These are things we want to look at. We want to combine supply and demand basics. We want to look at who's controlling the market, the bulls or the bears, and then we want to bring in some key technical indicators to identify those pivot areas. Now, with Euro-US is being driven by Euro-Great Britain. And when the pound strengthened based on that UK unemployment report last week, Euro-Great Britain sold off hard. So while Great Britain-US moved up, Euro US couldn't. Bottom line, it couldn't move up. So what we have to look at here, which is very important, I want to run through this. You can see that the euro still has a mildly bullish setup here on the monthly time frame. We're trying to push above that trend line. So the opening price for the month of April, this is what I want to point out, and I try and share with my own direct clients and work on with them on a regular basis, is that we've opened the month 21 days ago at 167.68. How many people in the audience today have been stopped out multiple times on Euro US, long and short? I'm willing to bet quite a few. And the main thing is nowhere to put those stops. If you're going long, keep those stops below the opening price for the month at 137.68. If we look at this, we open the month at 137.68. We only get the low of 136.72, and that was in thin illiquid markets on a Sunday or an early Monday trade, and it immediately overtook that 137.68 again, and we have predominantly stayed above that level for the better part of the month. Now, when we look at it on the weekly, any one of these candles, if I go back, you can see it was 3 weeks ago that we hit 136.95. But if I move over to the next candle, the low of the next week's candle is 137.89. The low of this is our current week price of 138.11. So we want, the area you're looking at very closely is between 137.68 and 138.11. So we could pull back tomorrow around 137.68. But if that area holds, then we're going higher. If it doesn't hold, then we know we're below the monthly open price, we're below the weekly open price, then we should be sellers, right? That's the way we want to focus on this. Now, key level there is we've got just a simple 6-day moving average, 137.99. We're sitting on that now. But again, 136.85 on that 25-day EMA. We're above the 100-day EMA on the weekly. We're above the 100-day EMA on the daily, and we're above the 100-day EMA on the monthly. So realistically, guys, we're looking for a pullback to buy. That's realistically what we're looking at. Now, big power struggle between the FOMC and the ECB. So it wouldn't surprise me if the euro crashes, because Draghi's going to talk it up and try and weaken the euro just like Yellen did. And these two are going at each other and try and stay out of the way. That's why I would probably recommend to stay more lean towards some of the other pairs like pound dollar, US CAD, some of these pairs, because the euro is very speculative. It's the top traded currency in the Forex, and that's not always a good thing, trading the top currency with the highest volume. Volume's not always your friend, okay, because it's prone to this kind of chop from one little word out of the central banker, and everybody's running for cover. So be careful of that. Now, again, with US Swiss franc, I think we have some opportunity here, but the first thing I want to point out, this is nothing more than a Euro US trade. That's what US Swiss franc is. Euro US goes down, US Swiss franc goes up, or vice versa. Okay, it is that simple. So going into a lot of analysis on this is to some degree pointless. So when we look at the monthly open price, very, very important that I point this out, because it's 88.44. Last week, we spent the entire week between 87.70 and 88.44. That's the weekly open price and the monthly open price. And you can see that we're knocking on the door of this 88.44. On a break of 88.44, when we talk about a key breakout points to watch, there's two key points that I want you to watch on US Swiss franc. You buy above 88.44 and you sell below 87.77. So when we look at this candle from last week, very interesting candle. I'm going to bring that up again. You can't see it. Go to your left side of the screen. We have a low of 87.63 and a high of 88.34 for the entire week. Okay, so you shouldn't be getting stopped out here. If you know your levels and you know where your immediate trading zone is, you shouldn't be getting stopped out on longs or on shorts. Okay, and then when the breakout does come, I've now told you those levels to watch. If we get above 88.44, then buy it. If we get below 87.70, then sell it. That's how you want to play this. Okay, and you can see that entire week. That's all this thing did. Now, looking at supply and demand basics, we've got good trend line support down around the 87 mark. So we're a little ways away from there. That concerns me on the weekly. But in the daily, we can see more of a bullish picture setting up on this. The 6-day acting as support at 88.10. We've got a 25-day EMA there, and we've got trendline support at 87.50. So if we're going to buy this thing, we've got to keep our stops below 87.50, guys. Okay, very, very important. Moving right along, let's go into our next major pair, which is the dollar yen. This is, again, another interesting one. Now, what we want to look at is everything in this webinar is kind of pull it together. And it's going to be a little repetitive on how I'm doing it, but it drills home the numbers that you need to know for this week's outlook. Okay, and it's probably very different than what most of the analysts are talking about. So we have opened the price on dollar yen for the month at 103.20. Okay. We took a spike pre-non-farm payrolls up to 104.11, and within 48 hours, we immediately retreated back below 103.20, and then we hit a low of 101.31. So clearly, dollar yen has a bearish bias for the month of April. It has predominantly been below the opening price of 103.20. 103.20 has also acted as a pivot area to enter those shorts. Again, when we look at how crowded the long trade is on this, when the short trade, which is what I worked on with my own direct clients, was actually a fairly easy trade. When it started to turn, we also knew that level. So when we look at the weekly from last week, we have trendline support, but we also have, you can see that from last week, let me see if I can get in here, the opening price for last week was 101.60. We went down to a low of 101.40 for the entire week, and we've hit a close of 102.56. This points towards a very bullish, dollar yen had a very bullish week last week. The monthly is still predominantly bearish, while below 103.20. But again, if we look at that weekly, it's pretty strong. So here's the kicker, what I'm going to tell you about dollar yen. I'm going to bring that intermarket analysis back into this. You must watch the S&P 500. The bottom line is if the S&P 500 does not get above 1863 and crashes lower, it will drag dollar yen down with it. And I don't care what the US dollar does. It doesn't even matter. The dollar yen is basically 90% correlated to that S&P 500. So if you're in a risk-off scenario or just simply a weaker equity market, the dollar yen long trade doesn't stand a chance. And that's pretty much what I said in the last webinar, that if the S&P 500 can't move higher, forget about longs on dollar yen, at least for now. So the dollar yen, again, we've got 103.50. We've now got the weekly downside. So where does that leave us for this week? For this week, we have an opening price of 102.42. The dollar yen has its work cut out for it here, guys, to be perfectly blunt. We need to hold above 102.42 reasonably. We need to predominantly stay above 102.42, and that will tell us who's in control, the bulls or the bears. That's all we're looking for here, is who's in control. You do not want to beat the market, guys. Let me drill this one home, and this is something, again, I try and get across to my own direct clients. You don't want to beat the market. You want to join it, right? The bigger money. So if the bulls are in control of the market, the bulls are not Joe Retail, that's out there trading 10K lot sizes. Joe Retail he's the one going long, where the big money guys that are doing hundreds of millions of dollars, if not in the billions per day, those are the guys that'll be going short if we get below, if the equity sell off and we stay below 102.42 in the week. Those are the guys you want to watch. So again, you're not looking to beat anybody here, okay? You're looking to join them. It's just understanding which one of them is in control. And as long as they're in control, you stay with them. When they start to lose control, you jump ship and you go to the other camp, okay? You go from the bull to the bear camp. I do it every week and every month. That's currency trading 101, okay? So right now, on the dollar yen, it's got a bit of work cut out for it. So if we come into the daily here, it's looking a little bullish, but we've got this center Donchian band we've got to deal with. So a breakout scenario on this, we need realistically here, guys, we've got to get above this center Donchian band, 102.65. That could open the door back up to the 103.95, but don't forget that 103.20. So again, if you're watching the webinar here today, jot down a couple of numbers that I'm talking about so you can remember them middle, late week, because it's certainly going to make a difference in your trade. Now, I'm going to keep moving along here because I want to make sure I get to all the parent currency pairs, and we still have 3 to go. So I apologize. I tend to run over. Now, when we look at New Zealand US, the first thing we want to do is go through a very structured manner in which we're looking at this. So we want to look at the opening price for the month here, okay? The opening price for the month, if you can't see it on the screen, the left-hand corner of my screen, you can see that the opening price for April is 86.70. Okay, we hit a high of 87.43, basically shortly after the non-farm payroll, or excuse me, it was after Janet Yellen changed her rhetoric yet again in the FOMC minutes. Central banker contradicting themselves. Hard to believe, isn't it? So that drove it up briefly. And again, this is why I go towards, and I always tell my guys, forget about this news trading. It's silly. News trading is what it is it's gambling. You're betting on how the market's going to react and to a statement, and you're also betting on the statement itself. So it's a double-ended sword. No matter how you play it, it's a double-ended sword. So when we look at this, everybody's buying up New Zealand US up above 87, and then it just got slammed lower when the real money took a look back at this and said, no, we shouldn't be buying New Zealand US. So it took its spike down, but then we can see the low for the month is 85.12. So technically, guys, this is quite bearish, We're up against the standard Donchian band, resistance up above 87.50, the 88 level, and we're starting to aggressively move lower on this pair, okay? Now, when we look at it for the week, when we look at it for last week, again, a very interesting setup. 86.79 showed itself yet again. So we have the monthly and the weekly right around that key pivot level. So we got up to a high of, we only went 20 pips above the high of the week for last week. Once we got below 86.79, the bears clearly took control of this and they just pounded this thing down. Excuse me, to where it currently is, where it currently resides, all the way down at the 85.73 level. So there's a method to this madness. So you're looking for who's controlling this market. And you don't want to beat those people. Again, you want to join those people. Very, very important here, guys. So your Fibonacci and all this stuff, guys, throw it up. Please just take it with a grain of salt. Fibonacci was designed by a goat herder in the 16th century. We think it was not set up for trading. You know, if you have to use this tools like Fibonacci and Elliott waves, make sure that you're using the main tools of that. Fibonacci 61.8, okay, maybe there's a little something there, but all the other ones, 31.8 and all that, the market ignores them, guys. It's a bull bear trap. So try and stay away from that. So there was all kinds of Fibonacci levels between 86, 86.90, 86.70 from the move up to the 38% move from 86.50 to 87.50. That's a retracement. You buy at 86.50, and then you're stopped out immediately almost. And I've seen this a million times. The bottom line is the bears took control of the market, and they continue to control the market on this pair, keeping it simple. Okay, on the dailies, when we look at the dailies on the New Zealand, again, a lot of resistance up here now on the daily time frame around this 86.13 area. So the one thing I want to point out here, I'm going to come back to that for a minute, is just to let everybody know, the opening price for the week is 85.70. The opening price for the month is 86.79. So you've got a 100 pip buffer in there to set your shorts. Okay? Unless we get above 86.79 and stay above that, then you should be selling between the current level, which is a little bit low. You know, let it try and push tomorrow towards 86.30 or so, 86.20. Get it up, try and get it short up around that area. But know your levels and where to put those trades in, and you'll leaps and bounds in your trading, and try and have the minimal indicators that you need on here, and always identify supply and demand. So those are our levels for New Zealand for this week. Now with the US CAD, I am turning quite bullish on this pair. The key level we have to take out here, guys, is 110.47. Okay. 110.47 is where this opened the month of April. 21 days later, we are now, 20 pips from that number? So like a moth to a flame, that's coming right back to it. So if it can overtake this level, we are going to take a big spike to the upside. Okay, so that it's not about being right or wrong in trading. It's never about that. It's about knowing the levels and anticipating your opponent's next move, or in the alternative, climbing on board with bigger money. And bigger money is probably potentially going to start buying. So you can see we've got trend line support there. We've got a bullish pin bar, US CAD pushing higher. The opening price for the week is 110.20. This is an important number. So now we have an opening price for the month, or excuse me, the week at 110.20, the opening price for the month at 110.48. So potentially there are either two powerful resistance levels here or two very powerful support levels forming, and a new trend is forming. And by trend, guys, trends are 7 to 21 days, maybe 30. Okay, you can look at the bigger, broader trend and draw in channels and all these different things. But the bottom line is, guys, even the US dollar, even though we don't like the US dollar, we know everything that's going on there is really horrible and the twin deficits, but they have to settle their trade deficits. They have to buy dollars. Big money governments have to buy dollars, whether they like it or not. So this makes it stable. The currency market for the most part is stable, where, you could have a stock which will go, it could increase by 300%. For a currency to increase or decrease by 300%, it would take a century. It would take a lifetime, right? So that's what makes currencies interesting, but don't lose sight of that supply and demand. There's demand for a currency, not because it's valuable, it's because a government has to buy it. To settle, the U.S. has to buy euros to settle its trade balance, because the Europeans don't want U.S. dollars. They want their trade balance settled in euros. And the U.S. then turns around and says the same thing. Okay, well, you have a trade balance with us. We want ours settled in dollars. So each month it's a back and forth, back and forth. That's how it works. Okay? So when we look at this right now, we look at the US CAD, the opening price for the week, this 110.20, very important. So the low today, 110.06, but that monthly, don't forget about that monthly. So when we start working our technical indicators into this, our supply and demand, pretty heavy support forming down here, right around this 109 area. We've got the 100-day moving average down there, 109.18. I would suggest longs while we're above that. Then when we look at this simple 6-day moving average, there's no other moving average in there crossing over. It's simply acting as a pivot area. Again, 109.96, right? You can see the market's hugging that area. So as it crosses over the 6-day, it goes down, 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 down. Then when it crosses over it, it usually goes up, up, up. Okay? Keeping it simple. And this scenario, if we can get above this area, there's the 25-day moving average on the 110.45 level. Also, a break of that area, guys. This is breakout points to watch 101. When everybody else is selling, do not be afraid to buy at this level. If this thing goes to 110.60, buy it, okay? And the reason you do that is because it's taking out all these key levels. The bears are losing the battle. The bears are losing the battle right now, guys. They started to lose the battle the middle of last week. That's why with my own clients, we've been buying this thing down around 109.50, 109.80, particularly every single day. Buy, buy, buy. Okay, so keep that in mind. Very, very important. If you know those levels, this will help considerably. Now, I'm just checking my things quickly here for questions during the webinar. Which is the correlation again between the S&P 500 and the US dollar? S&P up, US dollar down. GFB, that is correct. Yes. So if the S&P 500 cannot overtake that level of, say, 1863, 1864 on the future side, then the dollar is going to take a footing, and that correlation is still there. So if the dollar is up, then the S&P 500 is usually down. If the S&P 500 is up, the dollar is down. That's usually the correlation there. So with the US CAD, getting back to that US CAD, again, we do have a fairly bullish setup. It's RSI. I haven't talked too much about it in this week's webinar, but the main thing I want to point out is we're sitting at 57. And again, I'm using this as a momentum indicator, not as an overbought or oversold condition here. I want to buy strength, right? And I want to sell weakness. And if I'm buying strength, the bulls are in control. If I'm selling weakness, the bears are in control. So this is the play that 70% of the market will not do. If it gets so high They look at it and they say, and my own clients do this, and they say, ooh, I'm just selling. I'm only a seller. Not the way to think here, guys. Again, you're not wanting to beat them. You're wanting to join them. So I've got to get into my last pair here because I am out of time. So what we're looking at here with the Aussie US. When I talked about this in the last week's webinar, just a week or two ago, I told you guys I was very bullish on the Aussie, and it went shooting up well up above the 94 level. But there was a reason why I'm bullish. I'm not blindly bullish because I think it's going to go up. I'm bullish because I want to know who is in control of the market. So if we go through our scenario, we look at this on a monthly time frame, the opening price for the month is 92.63. The low is a mere 92.05 for the entire month, not even 50 pips, about 50 pips. But the upside, it's all upside, guys. That's all it is upside. So we look at this key level, and they're talking it up right now that the Aussie's going to weaken, which it might, but know your level. 92.65 is the opening price on the month. When we look at it on the weekly, the Aussie definitely had some weakness last week. The opening price was 93.88. We got up to 94.24, but then it started to lose ground and it slipped below that opening price. Now, for this week, though, it looks a little bit better for the Aussie. The opening price is 93.34. So we want to stay above this level, and we want to stay above the 92.65 area. So your buy zone for Aussie US is between 92.65 and this current level right here. So obviously we want to try and get as close to that 92.65 as we possibly can. And one of the manners in which I've talked about with the Aussie US, when I was asked about that, well, why are we buying Aussie US? Everybody says it's going lower. And this was back on the monthly. This is a good point, case in point, that I want to show everybody. This was back in March, okay? In March of this year, we had an opening price of 88.93. So if you can't see it there, you can look on the left side of the screen. We've opened at 88.93. We hit a high of 92.84, but the low price for the entire month was 88.89. This is incredibly bullish. And this then in turn led right into the month of April. And you can see, if we look at these candles, the tips of these candles, every one of these months in the last 3 months has made a higher high. So if something is making a higher high, it's staying above the monthly opening price, why would we sell this? Do we think that selling this would be a very dangerous play? The answer is yes. So remember, try and pinpoint the area where the bulls are the bears and where the turning point, where the breakout. When the breakout point happens, when everybody else is selling, in most cases, you're buying, and vice versa. Okay, that's the way we want to think of it. So I'm at my limit on the webinar here today. So I'm going to pause for a second. If you guys have any questions, I'll take a moment before I close up and ask you guys, or I'll answer any of the questions anybody on the webinar here might have. A lot to absorb in a very short period of time. Now, again, if anybody has any questions about the webinar, you can you can email me at etradefx@gmail.com, or you can visit my website at www.etradefx.ca for Canada. I've got some very good emails from the last webinar and questions about the webinar, and I certainly appreciate that. And I look forward to talking to everybody. There's nothing more exciting than talking about trading and learning new things. And everybody's always learning things. And that includes me. Okay. So, we have I wouldn't say a tricky week ahead of us next week. I think what we have is just towards the end of the month, price becomes a little choppy. And there's profit taking, there's all these different things. And we just need to know the levels, and we need to get prepared actually to some degree for next month's trading. So when, like I said, using Aussie, that's why I've used Aussie US as that example, because what I did in March, I simply moved over into April, and there would be, as much as everybody is selling, even at the 93.85, that critical level, I was still buying. So, and it's just understanding that it's not what I want to do. It's not what Greg Firman thinks or what any of your other analysts out there think. It's about what the market is doing. If the market is buying, then somewhere in there, that's not retail. That's institutional. And those institutional flows are things you definitely want to keep your eyes open on. So I think I'm clear here today. Just let me see. Got some other questions that came through to the administrator. What time frame do I trade on? As you can see, I am taking signals from multiple time frames. So I am looking at those time frames on the monthly, the weekly, the daily. My entry point will then can come from the H4 or predominantly the H1, predominantly the H4, I should say, or the H1, either one. But I'm going to trade with the same indicators that I showed you guys here today. And I'm going to put that into the lower time frame for my entry point. Now, another question, how you handle economic data releases and news. That's an easy question for me to answer. I avoid them. And just like I said in the webinar, that's a sucker's bet. It's gambling. The people that think that they can trade off these news announcements, it's somewhat comical because it's such easy trading the next day. So, why would I want to trade during that announcement in the hopes that and that's all it is. It's a whim and a hope that I'm going to be right on what the announcement comes out. Look at the FOMC, for example. The FOMC was pretty hawkish in the press conference, and then the minutes come out and it sends the market spiraling in the opposite direction against the dollar because the minutes didn't match the statement. So both of those two announcements, with the two announcements, like, just to clarify your question, I should clarify it a little bit, is that I do trade normally with normal economic data, like CPIs, GDP. These are not big announcements. The FOMC and the non-farm payroll are two things that I avoid, and I advise my clients to avoid them because you cannot predict what that number is going to be definitively. So if I have clear supply and demand, if I have a clear understanding of who's in control of the market, the bulls or the bears, then I have some degree of control over my trading. When I enter into something like that, I have no control over anything. I am at the mercy of the market. We absolutely do not want to be in that position. That is a very uncomfortable position to be in. And that is my best advice I can give you. And that is the same advice I give my own direct clients. Do not get involved with this. You've only got a couple of days of the month that you really have to be concerned about these types of reports. So that leaves us with 20 some odd other days of great trading. So why risk it, guys? That's my best answer to that question, because I think that's a safe way to do things. Okay, I think probably good to wrap up. I know that there's other webinars coming up here, and I want to make sure that I'm not running too far over. I certainly want to take the time to thank everybody for attending here today. I really appreciate you guys coming out, and I really appreciate FX Street hosting. They do a fantastic job. Great website. Do I make one last question here, do I make your trade decisions based on the daily close? I absolutely do not. I look at the daily opening price for the next day, but I'm more concerned with the weekly and the monthly opening price and how we're trading that. But looking at what you should be looking at, Slim Bache, what you should be more focused on, what I will tend to make a decision on, is the opening price, not the closing price. The closing price doesn't carry that kind of weight. So if let's say, for example, I'm above the opening price for the week, I'm above the opening price for the month, then I'm above the opening price on the next day's trade open, I'm very likely you'll see me going long. And that's why all of them are in line. And the good thing about the way I've talked about it today here, using those areas, is that they're not moving targets. A moving target is a moving average crossover. A live moving average crossover is schizophrenic. If you ever watch it in a 1 minute time frame or on an expert advisor, it's crossing the trigger. The moving averages cross like crazy. But that's what I would call a moving target. But a target that's just sitting there is much easier to hit. it's much easier to identify, right? Where a crossover point, I'm sure this has happened to everybody here, including myself, you could have a moving average crossover, you leave your computer for a couple hours, come back, but you enter a trade on that crossover, you come back, and the chart shows there's no crossover anymore, and there never was one. That's the downside with a crossover like that, is that it tends to give those signals 1 minute, and then a few minutes later, it turns around and says, okay, there is no signal here. Same moving averages on all time frame. Just move your time frame. I set a template on there, and all I do is move back from the one, the D1, the weekly, the monthly. With my own direct clients, I even provide them with an indicator that shows the candle open price on the chart, so I can see it from one time frame. So if I'm on the 1 hour time frame, I can see the opening price for the weekly, the monthly, the daily, and whether the market's trading above or below that area. So I can very quickly analyze how the market looks. So I know there's another webinar coming up here, so I better close things up for the day. But again, I want to thank everybody for attending here today, and I look forward to seeing everybody on the next presentation. Thank you.